If you haven't started investing yet, if you just started investing, or if you've been investing for a few years, this video is for you. These are 5 common mistakes that most investors make that are easy to fix and will have a huge impact to your portfolio's performance over the long term. Some of these are hard to understand without numbers, so for most of them, I'll give you an example with numbers, and trust me, these examples will blow your mind. For those of you who don't know me, my name is Nakul and this channel is all about simplifying investing. So if this kind of content does interest you, do consider subscribing. Let's get into it. There's a generic saying that goes something like this. The best time to start investing was yesterday. The second best time is today. So you've just started earning money, or maybe you've been earning money for a few years now, but you haven't really started investing. Maybe you've dabbled in investing, but you haven't really committed to the process. The first mistake that you can make is starting to invest late. And trust me, the example I'm going to go through will shock you. You and your friend both start working at 22. He starts investing as soon as he starts working. He invests $500 a month while you wait to start investing. At 30, you finally decide to start investing, while your friend stops investing any additional money. You invest the same $500 every month from the time you're 30 till the time you're 60. Both of you get an annual return of 10%. By the time you stop investing at 60, you have $1.14 million. Not bad, right? How much money does your friend have? He ends up with $1.48 million. How? You invested a total of $180,000 over 30 years, while he invested just $48,000 over 8 years, and he still ended up with significantly more money than you. It's because of compound interest. I've explained this term on this channel before, but sometimes it's hard for our mind to fathom how much of an impact this simple concept can make to growing our wealth. Compound interest is a concept in investing where the money you invest makes you more money over time, as long as you remain investing. What this means is that the money you invested grows exponentially over time. Money you invested 30 years ago makes you much more money than money you invested 25 years ago, which makes you much more money than money you invested 20 years ago, and so on. Now, why do people start investing late? The main reasons are you don't think you have enough money yet to start investing, you're worried that you don't know anything about investing or what to invest in, or you're like me and you love to procrastinate. Let's talk about each of these. No amount is too small to invest, especially when you're young. This doesn't mean you start investing with $1, but even if you start with $100 a month, that's an amazing start. And because you're starting early, this money will compound and have a much bigger impact than investing a larger amount later. For example, investing $100 when you're 20 is going to make you much more money by the time you're 60 than if you invest $1,000 when you're 45, assuming a 10% annual rate of return. If you're worried about what to invest in, or you're worried about losing money, start simple. Invest in an S&P 500 ETF. IVV and VOO are 2 examples of such ETFs that are extremely cheap and great investments. As long as you're investing this money for the long term and don't plan to sell your investments in the short term, there have been multiple studies that have been done taking data points over the last 50 years that have shown that historically, there's a 0% chance of you losing money. And on average, you will get a 10% return as long as you hold the S&P 500 for 20 years. So start investing today. Investing early will always have a bigger impact on your long-term wealth compared to waiting for the right time to get in or trying to pick the stocks that will outperform. The second mistake is investing too little. Wait, what? You just told me no amount is too little to invest. There's no problem investing small amounts when you're earning small amounts, but make sure that you don't continue investing too little as your income increases. Many investors start investing in the stock market and then don't commit to the process of investing for a long time. They may have $50,000 to invest because they've saved that up over 6-7 years, but they'll only invest, say, $5,000 of it. Often you'll hear people say that their portfolio was up 30% last year or their portfolio was up 40% last year, which is amazing, but only if it's true. If you have $50,000 saved up, but you're only investing $5,000 of it and keep the rest in cash, technically, even if your $5,000 went up 40%, you only made $2,000 from the $50,000 you had to invest. So you only made 4%, which isn't great. Often investors do this because they're investing in stocks with the hope of getting large returns in the short term and aren't willing to invest all their money into these companies because that would be too risky. Instead of investing in individual stocks that could give you high returns with a small amount of your capital, you'd rather invest in larger, safer companies, diversified funds, and fixed income, which will give you lower return on the amount invested, but higher total return because it involves less risk and you will feel more comfortable investing more money. Minimizing the amount of excess cash you hold, excluding your emergency savings, is critical to building long-term wealth. I've done a video specifically on this where I go through an example where I show you how holding extra cash can cost you hundreds of thousands of dollars over the long term. I'll link it in the description below. The third mistake investors make is thinking they're experts at investing when they've only been investing for a short period of time. I mean, we've all been there. You start investing during a bull market, everything is going up. The riskier the stock, the higher the return you're getting, and your portfolio is doing better than any ETF, index fund, or mutual fund. And you start thinking you're an investing god. You increase how much you're investing in higher risk and lower quality companies, only for the next bear market to come and wiping out all the money you made. And you finally realize you might not be the investing expert you thought you were. This is known as the Dunning-Kruger effect. The Dunning-Kruger effect is a type of cognitive bias that causes people to overestimate their knowledge or ability in particular areas, especially those they have little to no experience in. Graphically, it looks like this. You initially overestimate how much you know about investing, and over time you learn that you don't know that much. If you're just about to start investing and haven't experienced this yet, be aware of this cognitive bias. It'll save you one market cycle of pain. If you've experienced this and are feeling demotivated, restart, but this time simpler. Build a core portfolio of diversified funds. If you're looking for the best equity index funds or dividend index funds to pick, I've done videos on that before, and again, I'll link it in the description below. If you still want to try your hand at stock picking, that's fine as well. We all have itchy fingers and that's normal. Follow a core satellite approach where you invest at least 80% of your portfolio in core long-term holdings and a maximum of 20% of your portfolio in stocks that you actively manage with the aim of outperformance. Another common mistake investors make is thinking timing the market matters. It doesn't. A lot of investors are so hesitant to invest in the market because they think that prices are too high or it isn't the right time to invest. And as a result, they hold on to cash waiting for the right time to buy. When markets are down and prices are low again, they don't invest because there's a negative sentiment in the economy and they're scared the market's going to fall some more. When the market rebounds, it rebounds sharply and fast. And again, they're worried that they missed their opportunity to buy, and so again, they don't invest. Yes, market timing is very, very hard. But most importantly, market timing doesn't matter. The price you enter at doesn't matter, as long as you keep deploying the cash you're saving immediately into high quality investments. Our friends at Reddit did a little research and showed the difference in the performance from 1979 to 2020 of two people, Bob and Sam. Bob used to time the market perfectly. He saved $200 a month in a savings account, earning 3% interest, and correctly predicted the exact bottom of each of the 4 crashes during that time, and invested all of his saved cash on those days. Once invested, he held his S&P 500 index fund while saving up and holding excess cash in his savings account waiting for the next market crash, and repeated the process. For this impossibly perfect market timing, Bob was rewarded. The $96,000 he invested over time grew to approximately $956,000. Sam was different. He didn't try to time the market, he didn't watch stock prices or listen to the news. In fact, he only did one thing. On the day he opened his account in 1979, he set up a $200 per month auto investment scheme in the same S&P 500 index fund Bob invested in. Then he never looked at his account again. Sam's slow and steady approach grew his nest egg to approximately $1.4 million. Even though he didn't have Bob's impossibly perfect ability to know the bottom of the market every time, Sam's investments crushed Bob's by more than $400,000. So if you're worried the market is too high or we're due for a crash, or you want to wait for the inevitable drop before you put your money in, think about whether you'd be as good as Bob was in timing the market. And even if you are that good, realize that this is still a losing strategy versus the early and often approach that Sam executed. Timing the market doesn't matter. Allowing more of your money to spend more time in the market is always going to be the winning strategy. That's why there's this common saying in investing that I've mentioned before on my channel that goes something like this: time in the market always beats timing the market. The last mistake is letting your emotions get the best of you. Today, with the abundance of information available, the rise of social trading and meme stocks, and attention-grabbing headlines, buying because of FOMO and panic selling are huge mistakes investors make. This causes you to buy poor investments at high prices and realizing losses by selling investments at low prices. One of the best ways to prevent letting your emotions take your investment decisions is to set up a systematic investing process through dollar cost averaging, where you invest equal amounts regularly regardless of the price. Just like Sam did. Systematic investing compels you to continue investing the same amount regardless of the fluctuations in the market, helping you avoid the temptations to time the market or let your emotions get the best of you. If you want to know about dollar cost averaging, you guessed it, I've done a video about it in more detail and I'll link it in the description below. I hope you found this video useful. If you did, do smash that like button. Subscribe if you're looking for more content on simplifying investing. Check out this video if you want to find out 13 interesting facts about a recession. I highly recommend it. I'll see you in the next one.